The lines between traditional banking and the digital asset world are blurring. Imagine one of the most prominent blockchain companies obtaining a US national bank charter. How could that reshape payments, stablecoins, and the very notion of money? Today, we explore why Ripple Labs has applied for a national trust bank charter, what the license would allow, and how it could affect both crypto users and conventional banks. Ripple Labs is best known for its XRP digital asset and blockchain-based payment network. Beyond XRP, the company has evolved into a global payments provider that helps banks, payment firms, and businesses move money across borders quickly and cheaply. In late 2024, Ripple launched RLUSD, a US dollar-backed stablecoin. Like other payment stablecoins, RLUSD is designed to maintain a one-to-one peg with the dollar and to be redeemable on demand. By July 2025, RLUSD had a market value of around $470 million, ranking it among the biggest dollar-backed stablecoins. In the United States, the Office of the Comptroller of the Currency, OCC, can charter different types of banks. A national trust bank charter is a limited-purpose charter. It allows a bank to custody assets, manage client funds, and perform fiduciary services, but it cannot accept deposits or make loans. Trust banks differ from full-service commercial banks because they don't take retail deposits, yet they still operate under federal supervision. The charter is attractive to digital asset firms because it provides the prestige and legitimacy of a national bank without the heavy capital and liquidity rules of deposit-taking institutions. National trust banks historically served wealthy families and institutions, but in 2021 the OCC issued interpretive guidance that expanded their powers to include custody of digital assets. This opened the door for fintech and crypto companies to seek charters to hold stablecoin reserves and access federal payment systems. So far, only a handful of companies, such as Anchorage Digital Bank, have received such charters. Others, like Paxos and Protego, had conditional approvals lapse. Ripple's July 2025 announcement that it had applied for a national bank charter marked a strategic shift toward regulation. The company's CEO argued that being a federally regulated bank would allow Ripple to integrate more deeply with the traditional financial system, signaling compliance to institutional partners. A national charter would also let Ripple operate across U.S. states under a single license, removing the patchwork of state money transmitter licenses it currently needs. Analysts have noted that obtaining the charter could give Ripple a stamp of legitimacy and help it compete with mainstream financial institutions in payments. The charter would allow Ripple to combine stablecoin issuance, custody, and payment services under one roof. According to the company's application, the proposed Ripple National Trust Bank would manage RLUSD reserves, hold digital assets for clients, and provide fiduciary services. Currently, RLUSD is issued through Standard Custody and Trust Company, a New York regulated trust company. By obtaining a federal charter, Ripple could bring custody in-house, reduce reliance on third-party banks, and possibly lower settlement costs. That could mean faster, cheaper cross-border payments for Ripple's customers. Perhaps the most significant motivation is access to a Federal Reserve master account. Ripple is seeking a master account that would allow Standard Custody and eventually Ripple National Trust Bank to hold RLUSD reserves directly at the Federal Reserve and use the FedWire and FedNow payment systems. Holding reserves at the Fed could reduce counterparty risk and provide real-time settlement around the clock. Instead of storing reserves at commercial banks, which introduces credit risk and fees, the master account would let Ripple treat RLUSD reserves like central bank money. This aligns with proposals in the Genius Act and other legislation that require stablecoin issuers to hold reserves in cash or at the Fed. Ripple's history with regulators has been turbulent. In 2015, the company paid $700,000 to settle accusations of operating as an unregistered money services business and lacking an adequate anti-money laundering program. More recently, a U.S. court found that Ripple recklessly violated securities laws, leading to a permanent injunction and a hefty civil penalty. By seeking federal oversight, Ripple appears to be signaling a new compliance-focused era. Under OCC supervision, Ripple would need to meet stringent capital, audit, and risk management standards. Supporters argue that this could help the company build trust with banks and regulators, potentially smoothing the path for RLUSD adoption. The U.S. regulatory environment for stablecoins is evolving. In mid-2025, the Genius Act, a bipartisan bill that sets reserve and disclosure requirements for payment stablecoins, passed the Senate. But its rules won't take effect until 2027. Meanwhile, the OCC's guidance on digital asset custody and trust banks has been challenged. By voluntarily seeking OCC oversight, Ripple positions itself to comply with future legislation and demonstrates willingness to play within the regulatory framework. This is a stark contrast to earlier years, when the company fought regulators over the status of XRP. Now Ripple seems to be betting that regulation is the key to mainstream adoption. If the OCC approves Ripple's charter and the Federal Reserve grants a master account, several benefits could follow. Improved settlement efficiency. A trust bank charter would let Ripple settle transactions faster and at lower cost by bypassing intermediary banks. Customers could exchange RLUSD for dollars within the bank's own ledger, reducing reliance on correspondent banking. Increased credibility. Federal regulation could make RLUSD more attractive to institutions that currently avoid crypto due to compliance concerns. With both state and federal oversight, RLUSD might be seen as safer, helping it compete with larger stablecoins like USDC and USDT. Cross-border payments advantage. Ripple's core business is cross-border payments. With a master account and trust charter, the company could integrate RLUSD directly into its payment network, enabling instant settlement in multiple currencies via on-chain and off-chain rails. This would challenge the SWIFT messaging system and possibly reduce foreign exchange spreads for businesses. Not everyone is enthusiastic about Ripple's banking ambitions. Community bankers and trade associations warn that stablecoins could drain deposits from the traditional banking system. The Independent Community Bankers of America, ICBA, and other groups argue that a stablecoin like RLUSD is functionally similar to a demand deposit because it is redeemable one-to-one for dollars and can be used to buy goods and services. Treasury officials estimate that if stablecoin issuers paid interest, up to $6.6 trillion could flow out of bank deposits into stablecoins. Even without interest, large transfers from deposits to stablecoins would reduce the funds that banks rely on to lend to communities. Traditional banks also worry that a national trust bank charter would let Ripple offer nationwide payment services without meeting the capital and community investment obligations that banks face. The Community Reinvestment Act requires banks to reinvest deposits in their communities. Trust banks are exempt from those obligations. Critics argue that granting a charter to Ripple would give it the benefits of federal legitimacy while allowing it to avoid responsibilities like supporting local credit needs. RLUSD reserves are promised to be held in safe assets, but stablecoin holders do not enjoy Federal Deposit Insurance Corporation (FDIC) coverage. Critics argue that many consumers may not understand the difference between a stablecoin and a bank deposit. The National Community Reinvestment Coalition, NCRC, notes that by operating under a national bank charter, Ripple could project the appearance of being federally insured, creating a false sense of security. If RLUSD's issuer failed, holders could face losses without the government backstop that protects bank depositors. Consumer advocates also point out that trust banks are not subject to the same fee-setting regulations as deposit-taking banks. Current OCC rules do not require trust banks to consider fairness or avoid abusive practices when setting fees. Without new rules, Ripple could impose high transaction fees or redemption charges without regulatory limits, potentially harming users. Critics warn that awarding charters to crypto firms could enable regulatory arbitrage. National trust banks would enjoy federal preemption of state laws. Without full supervision under the Bank Holding Company Act, the NCRC letter argues that issuing stablecoins is akin to printing money and taking deposits, so issuers should meet the same standards as traditional banks. Granting charters without clear rules could create a parallel banking system that bypasses consumer protections and capital standards. There are also concerns about systemic risk. The Genius Act's reserve and disclosure requirements won't take effect until 2027. Legal scholars warn that giving federal approval to uninsured stablecoins could increase the likelihood of runs that would spill over into the broader financial system. If consumers suddenly rush to redeem stablecoins, the issuers might need to liquidate treasuries or other assets quickly, causing market stress. The NCRC notes that stablecoins have become the currency of choice for criminals in recent years, accounting for 63% of illicit crypto transactions in 2025, and that fraud losses in crypto reached $9.3 billion in 2024. Another long-standing policy in U.S. banking is the separation of banking and commercial activities. National trust banks can be owned by commercial companies, which is prohibited for full-service banks. Critics argue that allowing Ripple, a commercial tech firm, to own a bank would blur this line and give the company unprecedented control over both payments infrastructure and commercial ventures. Regulators would have limited insight into Ripple's broader corporate operations, raising concerns about conflicts of interest and concentration of power. During the public comment period in July and August 2025, banks and advocacy groups flooded the OCC with letters opposing Ripple's charter. The NCRC's comment letter calls for delaying or rejecting any stablecoin issuer's charter until regulations implementing the Genius Act and stronger consumer protections are in place. The group emphasizes that granting a charter would provide a public subsidy and reputational benefits without requiring reinvestment in communities. It urges the OCC to extend comment periods and demand more transparency from applicants. Similarly, the ICBA has urged the OCC to rescind its 2021 interpretive letter that expanded trust bank powers and to undertake formal rulemaking. Banking trade associations, including the ICBA, Consumer Bankers Association and American Bankers Association, sent a joint letter asking regulators to pause all new trust bank applications from crypto firms, including Ripple and Circle. They argue that crypto companies don't meet fiduciary standards and that the application process lacks transparency. Traditional banks fear that charters for crypto firms will undermine decades of financial regulation. Whether or not Ripple's application succeeds, the case marks a turning point. In previous years, the OCC denied crypto firms' charter applications, Kraken for example, due to legal concerns. The new OCC leadership and pending legislation suggest a more receptive environment. Crypto firms like Circle and Fidelity Digital Assets have also applied for national trust bank charters, signaling a broader trend. Policymakers must decide whether to integrate stablecoin issuers into the banking system or keep them at arm's length. If regulators grant the charter, they will need to impose robust risk management, capital and consumer protection standards to prevent arbitrage and systemic harm. If they deny it, the US could fall behind other jurisdictions where regulated stablecoins are allowed. Either way, Ripple's application will influence how digital currencies and traditional banks coexist in the coming decade. Ripple's pursuit of a U.S. national trust bank charter reflects a strategic pivot from regulatory battles to regulatory engagement. Approval could give Ripple faster settlements, greater legitimacy, and access to the Federal Reserve's rails. It could also accelerate the adoption of RLUSD and challenge legacy payment systems, but critics caution that stablecoins mimic deposits, threaten community lending, and create systemic risks without deposit insurance or community obligations. The coming months will show whether the OCC embraces Ripple's proposal. For now, this high-stakes debate underscores the tension between innovation and stability. As the lines between banks and crypto firms blur, society must decide how to balance the benefits of digital finance with the safeguards of traditional banking. Stay tuned, and as always, do your own research before making any financial decisions. If you found this exploration informative, please like this video and subscribe to Express Econ Geofinance Insights for more deep dives into the evolving world of finance and crypto. Share your thoughts in the comments. Should crypto companies become banks? How should regulators oversee stablecoins? Your voice matters.